Lesson 8. Financial Modeling. A wise accountant once said, "If you don't understand your costs, you don't understand your business." Around 91% of startup failures are because of financial issues. Creating financials is often a great opportunity for entrepreneurs to learn some new skills. It's not as sexy as marketing, but it is absolutely essential. Just as you need to clearly understand the details of your product, market, and execution plan, the same goes into your finances. Most people find financial modeling to be the most daunting part of planning a business because it's all math and numbers. Don't fret, you will not be doing this alone. Take this opportunity to learn the basic vocabulary, types of financial documents, how to use a spreadsheet to crunch the numbers, and then double-check all formulas and numbers. You will use this information to create a first draft of your financials. After this, find a certified and chartered accountant to look at everything to make sure that you did everything right and comb through the financials with a professional eye. Taking the first stab at creating your financials means you're taking responsibility for every aspect of your business and ensures you become familiar with the numbers of your company, even if these may change when you consult with a professional. By the end of this lesson, you should have a fundamental understanding of the core critical numbers and their terminology that an investor, the board, and your bank will be looking for from you and how to come up with those numbers. Understanding the basic vocabulary of finance and accounting and being able to read numbers comfortably is critical to genuine success in business. It's surprising how many people try to float through life in business without learning finance and accounting, hoping that people will never notice. But there will be a point when important people will notice, and if you're not prepared, it could mean the difference between that strategic person, such as an investor or a mentor, trusting you or not. One of the misunderstandings about entrepreneurship is that investors give investment money to the startup itself. But the reality is that while the investors are depositing the money into the startup company bank account, that decision is based largely on their trust in the entrepreneurs themselves. So really, the money is being put into your hands. The company and offering is very important. Don't misunderstand. But it's the entrepreneur who will be making the decisions around how to spend the money. The product won't decide whether to spend the money on one activity or another. The human being with access to the bank account makes the spending decisions. This is precisely why you need to show that you understand how to plan and use the money wisely. Never, ever run out of cash. It might sound obvious, but it is critical that in all of your planning and conversations and forecasting and actions that you never, ever run out of cash. The CEO's primary job is to make sure that there is always money in the bank so that the payments that need to be paid can be paid. The CFO, Chief Financial Officer, has the responsibility to plan and carefully administer the money in the bank that the CEO made sure is there. The CEO has many other responsibilities as well, but making sure that money is in the bank is the most important part of their job. Keeping track of the ins and outs of cash is called the cash flow, and it tracks the cold, hard cash in your bank. You may have more money coming in the future, but if you let your cash flow run too low or cease, for example, if you make all company payments at once, your company ceases. Next, let's look at these common terms and review the differences between them. Do you know the difference between finance and accounting? Finance plans the future of the company's money. Accounting, on the other hand, keeps track of what happened in the past with the company's money. Even if the transaction happened 1 second ago, it qualifies as past. How about the difference between a payment and an expense? A payment is when money leaves your hands and bank account and is given to someone else. An expense is the agreed responsibility to make a payment at some future date. So, it's a future payment. People are often confused by payments versus expenses. One point of confusion in business is around expense reports, which are the means of requesting reimbursement or payment for the payments that we've already made. Example, a business lunch with a client, or a plane ticket for a business trip, etc. In this case, it's called an expense report because you have an agreement with the company that they will pay you back in the future for monetary commitments that you made in the past. Understanding the difference between a payment and an expense is very important when you're building your financial plan because the month in which you do something is not necessarily the same month in which you make an actual payment. You might commit to an expense in a month, but actually make the payment in a future month. You need to account for both events in your planning, but a payment has a very immediate and real cash impact on your bank account, while an expense needs to register as a payment that will be made in a specific month in the future. Managing expenses versus payments is an important aspect of cash flow. Ideally, ensuring cash flows in before out is the way to go. In some cases, you can control it, but not in others. For example, when setting up the agreement with your contractors, you may put in place a clause to say that they will only be paid after the client pays you. That way you can maintain a healthier balance in your bank account rather than perpetually being out of pocket, or worse, getting a reputation of being a bad paymaster. With clear expectations and payment terms in place, cash flow can be managed more effectively. What does it mean when an investor asks you about your sources and uses? Source means where you'll get the money from. This could be your own money invested, which is the most common source of early money in a company. It could also be money from friends and family, money from investors, grants from governments, and of course, actual revenue from selling your product or service, which will hopefully become the most consistent source of funds once you start selling your product or service. In your financials, you should estimate how much you will make or lose in a given month. Also state what and how much you expect to receive from your sources. Be prepared to talk about the activities that need to happen and what you're doing about it, leading up to that money hitting your account in the forecasted month in your financials. Uses means how you'll use the money. This typically correlates with the sources. Let's say that you have $500 from your savings that you're putting into the company. What will you pay for with that money? If you pay yourself back with a $500, then you didn't really invest it in the company. But if you use the money to register the company or to pay a software engineer to work on the product, then you invested the $500 in the company. If your parents or an investor give you $100,000, what will you use that money for? Will you buy equipment? Will you pay an engineer? Will you pay a lawyer for necessary work? What if the government gives you a $500,000 grant for R&D, research and development? You would need to use that money as directed by the rules of the grant, such as by hiring software developers and researchers from the local economy to do R&D and create your proof of concept. Have you created a budget before? A budget is the amount of money that you plan to spend. This is called a financial forecast on what must be spent. Very importantly, the amount that you plan to spend needs to link to how much money there actually is to spend in the bank account. Most people make the mistake of budgeting what they want to spend rather than what they're actually able to spend. People who actually plan a budget often spend more than what they planned. When you spend more than you plan, the money needs to come from somewhere, which then creates problems for anyone who needs to spend money on other things. It's important that an accountant tracks the performance of the budget. In addition, just like the do-or-die mission-critical task list, the budget should also prioritize the do-or-die expenses. As much as possible, it's good for a startup to stay as lean as possible and keep as many costs variable as possible. However, some costs, such as internet bills or staff salaries, cannot be avoided, and these would constitute the must-pay items on a budget. Just to digress a little on costs, back in the day, many costs that were considered fixed may now be shifted to a somewhat variable model. One classic example is rent, traditionally considered to be one of the most fixed line items on one's budget, hence the term cover the rent. These days, due to the changing nature of business models, it's not unusual for a small internet or digital company to operate out of the founder's home, essentially rent-free, and as the headcount grows, out of co-working spaces or a shared office. In the event of shared office or co-working spaces, the rent varies according to the number of workers, and that way keeps the organization lean. The must-pay amount of rent remains variable. Another trend to keep costs variable is to consider contract workers instead of full-time employees. Explore the idea if your business model allows for it. Contract workers not only give you more flexibility in payment timings and schedule, it also allows you to hire specialists without having to worry about fixed monthly salaries and other employee benefits such as insurance. In the case of a company building out an app or any other digital asset as its offering, having one contractor, for instance, build out the software, then subsequently hiring another to do the design and user interface allows you to pay for one engineer at a time. Compare this to hiring 2 full-time software engineers, one for the front end and the other for the back end. both not necessarily working on the product simultaneously. There might be weeks of lull where one of the engineers may have to wait around for the product to be built to a particular stage before taking over. This causes unnecessary additional strain on the company's finances and directly affects the burn rate and runway. Once the business achieves a certain level of success and growth, it may make more sense to get your own location and perhaps hire employees or even offer the really good contractors full-time jobs. But these are good examples of how you may budget to keep those must-pay bills lean. Spend some time to go through your cash uses line by line to optimize your expenses wisely. What is a cash flow? The cash flow is a window into how a company is being operated, where money is coming from, and how it's being spent. A cash flow is different from a net income statement, which shows how much money is left over after all money comes in and goes out. Money has costs, and a cash flow keeps track of those costs. Take interest, for example. If money you owe has an interest attached to it, then the money you need to repay increases over time. Similarly, if money that is owed to you has interest, then the money that is owed to you increases over time. There might also be unexpected charges and fees associated with things that are easy to overlook, such as bank charges or credit card late interest fees, and your cash flow keeps track of those. A cash flow also keeps track of accounts payable, which is the money you owe others, and accounts receivable, which is the money that is owed to you. It also keeps track of inventory, which is essentially goods you own, including product that you've built and are trying to sell. In addition, there is a line item called depreciation, which is how the value of a thing is lost over time, in particular to wear and tear. Think of how much is paid for a car when it's new, when compared to how much someone would pay for a car a few years later. Fixed assets, such as computers, furniture, and automobiles, typically have to be depreciated over time. A cash flow also keeps track of debt, loans, dividends, and investments that you make and receive in the company's name. From your cash flow statement, you should be able to derive at your burn rate and runway. These are important concepts to understand because investors, boards, and banks usually want to know what your burn rate and runway are. Burn rate is the amount of money that you'll spend in a given month, or the rate at which you use money. Runway is the number of months that you have until you're out of money. For example, if your average burn is $12,000 and you have $100,000 in the bank, how many months do you have before you run out of money? Approximately 8 months. So, you have about 8 months of runway. If your burn changes, meaning you end up spending more or less, then those changes will either shorten or lengthen your runway. For example, more money leaving your bank account shortens your runway. Frugality and more money being deposited into your bank account lengthens your runway. If you realize that your money is burning faster than you would like, you need to make some hard decisions about how to slow down spending so that you don't run out of cash. At this time, you should always be talking to investors about possible investment. If you wait until you're almost out of money to talk to investors, your chances of receiving investment is very low. Investors will look at the accounting of how you've spent money over time to see if they believe that you'll behave well if they give you money. Plus, it takes time to convince investors and time to finalize the paperwork and receive the money. If you don't give yourself time to go through the process, then you'll find yourself out of money, and that might be the end of your company. Think about the variable and fixed cost discussion we had earlier. Doing that line-by-line exercise regularly helps to sieve out unwanted costs and lengthens the runway. This is also where planning comes in most handy. The last thing you need is to be slapped with an unexpected expense that kills your cash flow and runway. Never, ever run out of cash. Repeat after me. Go on. Never, ever run out of cash. I didn't hear you. Go on. Stand up, take a deep breath, and repeat after me. Never, ever run out of cash. Good. Plan and work to the plan. You can do it. From your cash flow statement, you can also derive your first revenue, break even, and profitability. First revenue is when your company starts receiving money regularly from others. Others, meaning not your friends and family who buy from you because they want you to succeed. Break even is when you're regularly bringing in as much money as you're spending. This isn't a single moment, but it's when it happens regularly. Profitability is when you have money left over each month after you have paid everything that needs to be paid. Again, this is not a single moment, it's when it happens month after month. At this point in your journey, you're probably going to make educated guesses to your financials. This is known as pro forma financials, which are not exact or guaranteed numbers since you're still in the planning stage. They are at best guesstimates based on the information available to you while building the projections. The word pro forma is common among investors. It's recommended to label all of your financial documents as pro forma, so when an investor asks for your pro forma or pro forma financials, you'll know in an instant what that means. In your cash flow, you should also allocate some money towards travel and expenses, which refers to the amount of money spent on planes, trains, cars, hotels, food, etc., while conducting your business around the world. This is a very important budget line in your financials. Startups sometimes run out of cash because either they spend too much money on food and travel, or they don't keep track of it. When you run out of cash, you run out of business. So be very careful with what you budget and how you're actually spending it. Another important budget line item often missed out is the Market Development Fund, MDF. This is the money that you allocate to spend in order to take your product or service to your market. This is everything from website development to the costs of attending trade shows, to advertising on ads in digital or print magazines, to banner ads and Google AdWords, and any money spent on digital or printed brochures, etc. If your MDF is not carefully managed, it can bring your company to its knees financially, so be careful. When you're marketing, pay attention to another important budget line item known as the Sales Promotion Incentive Fund, SPIF. It's a powerful tool for motivating people to sell or buy your offering. A SPIF could be money that you offer or some other incentive that you give the salesperson every time they sell your product. If you're working on a smart device app or software as a service product, this could include any commissions or payments made for promoting or directing customers to purchase your offering. For example, you could partner with another company that has a smartphone app that has in-app purchases, and if one of their users buys your product from their app, then you pay the other company a fee as a SPIF. Another example would be a link from another company's website that leads their visitors or customers to a site to buy your app, then you would pay that company a fee as a SPIF. On the buyer side, a SPIF could be a discount or rebate or something else that you give a customer when they buy your offering. Pay a lot of attention when calculating the SPIF structure and amounts. Poorly managed SPIF can destroy the profitability of your offering. I'm pretty sure that most of you are not experts in finance or accounting. If that is the case, why do the financial execution yourself? Why not just hire an accountant? Well, you should hire an accountant. But do not leave the details of the financials to an accountant and ignore it yourself. You need to understand the numbers as much as your accountant does. You need to be able to talk about the numbers comfortably, like an accountant, with your investors, shareholders, and board of directors. If you do not invest in understanding your financials, the odds of your startup failing increase dramatically. If you feel that you have difficulty in creating financials, we suggest that you start with pro forma financials or educated guesses from your own experience and the best information available from other experienced people. Your finances and accounting will always be a work in progress. If you hold off until the next funding, expense, or decision, you won't know where your company stands today. Without knowing where you are at this point in time, you cannot strategically plan your company's future. Do not worry about what you don't know at this time. It's okay to anticipate, and it's smart to do so. It's best to know where your company stands at all times to keep your feet on the ground and your head out of the clouds. By tracking and planning financials every step of the way, you know what you have, and more importantly, what you don't have. You wouldn't blindly go shopping without knowing how much money you had to spend, would you? Eventually, your pro forma guesses become increasingly better because of accumulated experience. That takes time, and you need to start wherever you are now. Some of you might ask, I need customers first, financials second. Yes, you need customers, but your customers need to buy from a viable company that will be around next month and next year, etc. There are many factors in the financials that will impact your customers. For example, what will your offering cost the customer? How did you know to come up with that figure? If you don't do your financial planning, you're merely guessing and don't have any applied intelligence to the numbers. Are you going to pick a random number as your list price for your offering? How would you determine if customers are underpaying or overpaying? Or what if you're missing any number of things that they would be willing to pay for but don't have access to because you didn't plan? One such instance is warranty, if that applies to your product. What is a policy on a warranty for your offering? What does the warranty cost the customer? What do they get for that investment in a warranty? What is the cost to the company for offering the warranty? Another example. What is the cost of customer service and technical support? How will you pay for each telephone call or text or email message? How long will each customer engagement cost the company? As a final example, what if a customer wants a refund? Will you give it to them? What is your refund policy? If so, what are the associated costs? You need to think it through, or the reality of the associated costs that you did not plan for will harm you and your company. The more prepared you are, the more confident you will be in your execution. Knowing your financials and accounting are essential to your credibility as an entrepreneur. Get your hands dirty, work the numbers rather than hoping that someone else will do it for you. Your investors, board of directors, and team will all be relying on you to know the nitty-gritty of these numbers. It helps you have a clear understanding of where you need to steer your company, raise the right amount of money as opposed to too little money. Converse in the right language with your investors. Use the right terminology to express your company's financial story. If you do not know them, you will lose that critical trust needed to effectively work together. Most importantly, remember, if there is no cash in the business, there is no business. To recap, make your best effort to create an initial pro forma of your financials. Before presenting to the government, banks, investors, and strategic others, you should have a professional go through all of the numbers to make sure that they're right. Learn the basic vocabulary around financials, and don't make the mistake of saying, "I don't need to understand the numbers. I'll hire someone to do that for me." Put in the effort to learn the financials and accounting details of your company. If you genuinely get the numbers, there is a higher chance that you will never, ever run out of cash.